$55 and below. Why the oil crash is still coming. By Ward Ethan Mercer. August 5th, 2026. The paper market's current obsession with geopolitical friction is masking a fundamental structural reality. The global oil market is coiling for a massive physical supply flush. While headlines fixate on diplomatic posturing, war risk, insurance premiums, and localized transit bottlenecks, the underlying market substrate is quietly accumulating a structural surplus. The moment transit friction drops towards zero and physical supply channels normalize, the artificial risk cushion holding Brent above $80 will evaporate. What sits on the other side of that normalization is not a gentle slide back to equilibrium. It is a swift, mechanical drop into a lower price regime that threatens to carry crude towards $55 per barrel and below. The trapped backlog, breaking the dam. The most immediate catalyst for the coming price flush is the sheer volume of trapped physical inventory waiting for transit clearance. During extended periods of corridor friction, global extraction does not simply freeze. Producers across the Persian Gulf, non-OPEC hubs, and offshore platforms continue pumping, storing millions of barrels in onshore tanks, coastal terminals, and floating supertankers, idling off major maritime gateways. When the drama in the Strait is resolved, this accumulated backlog will not trickle into the market. It will flood refiners almost simultaneously. Spot physical barrels will be forced to compete aggressively on price, flipping the market's current backwardation into a steep, storage-filled contango. The unwinding of the OPEC Plus shield. While paper traders focus on short-term production discipline, the structural policy stance of key Middle Eastern producers has already shifted. Producers are no longer in a position, nor do they have the strategic appetite, to indefinitely surrender market share to non-OPEC competitors. The Saudi Aramco pricing signal. Saudi Aramco's aggressive cuts to its official selling prices for key export grades represent a clear operational shot across the bow. By offering flagship crude at steep discounts to regional benchmarks, the kingdom is preparing to defend and expand its market share the moment export channels clear. Capacity unanchored. Key producers like the United Arab Emirates have pushed production toward record highs, demonstrating a desire to monetize vast spare capacity. The quota rollback. The formal agreement among OPEC Plus core members to systematically phase out voluntary production cuts injects hundreds of thousands of additional barrels per day into the baseline. When the geopolitical premium disappears, OPEC Plus will be delivering more physical barrels into a market that no longer needs them. The non-OPEC Americas surge. While Middle Eastern supply has been temporarily constrained by administrative and kinetic bottlenecks, non-OPEC supply has been aggressively expanding to fill the vacuum. The Americas Quintet, the United States, Guyana, Brazil, Canada, and Argentina, continues to add structural volume to the global baseline. Elevated prices earlier in the year provided American shale and offshore deepwater projects with the necessary cash flow to complete capital projects and bring new wells online. Once Middle Eastern supply normalizes, it will not replace Atlantic Basin barrels. It will collide directly with them. The global market will be forced to absorb two fully operational supply engines at the exact same time. The demand ceiling and the macro squeeze. A supply flood alone is enough to pressure prices, but it becomes catastrophic for crude when paired with a cooling global demand engine. Global macro cooling. Prolonged high energy inputs, elevated interest rates, and trade tariff frictions have systematically degraded industrial throughput and global freight activity. Refinery margin pressure. Global refining margins have faced severe compression as end-user demand fails to keep pace with input costs. Refiners will respond to oversupply by slashing crude runs, removing a critical demand bid from the physical market. EV and efficiency transition. Structural demand growth in major consuming blocs, particularly across Asia and OECD economies, continues to underperform historical averages, leaving the market without a demand-side buyer of last resort. The valuation mechanics, how we reach $55. When physical supply dramatically exceeds demand, the price of crude is no longer determined by marginal production costs. It is determined by the cost of storage and production shut-ins. Phase 1, the premium evaporation. As transit routes open and geopolitical risk expires, paper crude rapidly drops from 80s into the low 70s. Phase 2, the physical glut. As the trapped backlog hits refiners alongside expanded OPEC plus quotas and surging non-OPEC output, spot physical markets break down, pushing prices through $65. Phase 3, the $55 stress test. To force higher cost production, such as marginal U.S. shale acres or high-cost international fields, to shut in and stop the accumulation of global inventories, price levels must test the $50 to $55 threshold. Conclusion. The market is currently living on borrowed geopolitical time. The elevated prices of today are an optical illusion created by transit friction, war risk premiums, and short-term logistical lockups. Beneath the paper surface, the structural balance of the global oil market is already tipped heavily into surplus. The moment the geopolitical dam breaks, the market will experience a swift, unhedged repricing. Sub-$55 oil isn't a radical bear case scenario. It is the inevitable destination of a market where supply is unanchored, demand is capped, and the physical pipes are about to open.